The following program is paid for and presented by Skybridge Media, LLC.
I'm Anthony Scaramucci. Welcome to Wall Street Week. Today we take investing out of the shadows and welcome the greatest short seller of all time.
And I'm Gary Kaminsky. As the Fed starts to normalize policy, there's no better place to figure out how to play the market than right here on Wall Street Week.
This show has never been solely about investments. We've talked about anything that affected people and their money.
From Times Square in New York City, the new Wall Street Week.
Welcome short seller extraordinaire, Jim Chanos. Jim, let's get started. How'd you end up on Wall Street?
Well, Wall Street was a difficult place in 1979, 1980. Nobody wanted to work on Wall Street. So I ended up going back to the Midwest and got a job in Chicago for a firm called Blythe Eastman Dillon. And I pointed out to people that in my first full year, I earned more in 2 months working in a steel mill in between my sophomore and junior year and junior and senior year as a union pipe fitter than I did at working on Wall Street with bonus. That's how bad Wall Street was in 1980.
So why'd you stay?
I was fascinated with the stock market. My dad had turned me on to the stock market when I was a kid and was always intrigued by it and was intrigued by it even in the 70s. And
So
the Dow was
what
about
was your
700.
first job? You were an analyst? Were you a
I was an
broker?
analyst at an investment bank for a couple of years, and then I moved over and became an analyst at a retail shop in 1982.
So how'd you go from those jobs into what you're doing today?
Well, the very first company I looked at was a well-known company called Baldwin United, which everybody remembers as the Baldwin Piano Company. It was a high flyer in the 80s, and it had morphed into financial services, insurance. It turned out to be a giant fraud, and I wrote it up. The company collapsed in late 82, early 83, and it was from that point on that our clients at the firm said, well, what else doesn't he like? And I had no predisposition to be a short side analyst, but I figured maybe I could make a living that way.
I mean, did it liquidate?
It was the largest financial bankruptcy in the United States history up until that time. And so it was a big deal. A number of large brokerage firms had huge exposure. It changed regulation in the insurance market. So it had some far-reaching implications well beyond just the bankruptcy itself.
So did you use that to springboard into your current firm, or how did you get your current firm started?
Well, from there I went, from there New York came calling, and I took a job with Deutsche Bank's brokerage arm, which at the time was called Atlantic Capital. And for the next couple of years I worked in New York doing sell-side research, writing up lots of companies. And then from there, I started my own firm in the fall of '85, so we're about to have our 30th anniversary.
Well, congratulations on that, but tell us the significance of the name.
The Kynikos were a group of ancient Greek philosophers who lived outside of Athens during the Golden Era. And they believed that self-discipline and independence of thought was the way to a true democracy. And they would challenge any demagogues who basically, were saying stuff that wasn't true. And you would recognize it as the root of the word cynic. They were the cynics.
Are you a cynic?
I think I'm a cynic in the classic sense of the Greek definition, which was not a pejorative as I think we see it in English today. The cynics were there to sort of keep people honest. And I think that that's one thing short sellers do in the marketplace. Well, I know we're often vilified, and people think we wear the black hats, but in fact, we are the only real-time financial detectives. And I like to say that short sellers are the financial detectives, and the regulators are the financial archaeologists. They're more than happy to tell you what happened 5 years later, but doesn't really help your viewers or my investors.
Jim, I come to the investing world much like you, thinking that short selling, not only is it relevant, it is sacrosanct to the investing world, because without it, you've got this one directional thing. But expand further in terms of what the role of a short seller is, so that the general public understands why short selling is so important to the capital markets.
Short selling occurs all the time in commerce and everyday life. Anybody that receives cash up front for delivering goods or services in the future is engaged in short selling. So if you think about a lot of businesses that we hold near and dear as in part of our everyday lives, they're short selling schemes. Insurance is a giant short selling scheme. The insurance companies collect premiums up front, they analyze your lifespan or the risk of your house burning down, and will pay out if those things happen. More importantly, in the financial markets, Bill Sharp, the famous financial economist, in his Nobel Prize-winning speech, pointed out that efficient market theory and capital asset pricing model are dependent upon frictional short selling. And what he meant by that was that people who don't already have a position or a viewpoint on an asset have to be able to affect pricing if they so choose. So if they think something is too expensive, they have the ability to sell that good or service and in exchange for providing it later. And you need them as economic agents to actually set prices.
In fact, when short selling was under siege, let's say in 1999 with the internet bubble, there was no true price discovery. A lot of viewers lost a ton of money back then because there was no price discovery, and therefore stocks would levitate based on the fact that there wasn't really a fair market being made with the absence of short selling.
And you see that in lots of markets today. Yeah. And whereby when the floats are very small and retail investors pile in, and professionals cannot take risk and set prices lower, people end up paying too high a price. And we've seen that over and over again down through history, not just in the 90s.
And so how do you think about risk management when you enter a short position?
When you short a stock, it can go up to infinitely. It can only go to zero. But I've seen far more stocks go to zero than infinity. So what you have to do, as any portfolio manager has to do in a construct of a portfolio, is simply set capital limits on each position. So if a position goes against you on the short side, you might still like it. And almost all our great short ideas, like Enron and others, have gone against us at some point. So you really have to just say, how much of my capital for my clients am I willing to risk in any one position? Maybe it's 2%, maybe it's 3%. In our case, it's never more than 5%. And just say, fine, if we love the idea, we'll just trim it back and never let one idea carry you out.
How have you adapted your strategy to the new environment of the Fed?
Well, since I started my fund when the Dow was 1,300, Anthony, I'm pretty used to the market going up. And we assume, by the way, that the market will go up over time. So what we've done is really we've structured our portfolios and our fee structures so that we are basically judged against the market. And so in effect, I'm always long the market and short my stocks. And that's just a better way to go through life in any way, shape, or form. So our clients are using us as a hedge. We will construct a portfolio for them so that they can either dial down their risk or actually keep their risk but overlay a hedge on it. And it's actually better than doing futures or buying puts.
But you're not just looking for frauds, right? You're just looking for things that are like mispriced.
Yeah, the frauds are there, but you really don't identify them too well into the story. Enron was a fraud, but we didn't realize it till the last 3 months of its life. But what you're looking for is flawed accounting, and there's a lot of that. You're looking for structurally unsound businesses. You're looking for businesses on the wrong side of a deep cycle. Any of those sorts of classic signs, as opposed to just simply something that is expensive.
What do you think about the overall way stocks and asset prices have moved in the last 7 years as a result of the central banks?
Well, my only two thoughts are as follows. It is the world we're in, so we have to adapt. We have to adapt and accept it, of course. But I do agree with my friend Jim Grant, who said, it's tough to make rational judgments on valuation when the central banks have their finger on the scale the whole time. But you have to deal with it. The second point is that for all of the QE that's occurring both in the US, Europe, Japan, and now ostensibly China, growth is no higher than it would normally have been. So it is just simply, and everyone agrees, it's going into the asset markets.
Wall Street Week will be right back. So it could easily drop 50% in the next...
And by the way, in every bear market, Sotheby's usually goes into single digits.
Did some individual in some basement in the UK create the flash crash? Is that possible?
Like us on Facebook, follow us on Twitter and Instagram. Wall Street Week is sponsored in part by Charles Schwab. Own your tomorrow.
Hey, Dad, who is that man?
He's our broker. He helps look after all our money.
Do you pay him?
Of course.
How much?
I don't know exactly.
What if you're not happy? Does he have to pay you back?
Nope.
Why not?
It doesn't work that way.
Why not?
Are you asking enough questions about the way your wealth is managed? Wealth Management at Charles Schwab.
Hi, I'm Andre Agassi, and I watch Wall Street Week.
We are back with Jim Chanos. If you were a part of the investment public, would you be long the market here? Would you be more skeptical?
Markets are unpredictable. And so in constructing any portfolio, you have to be long things. You have to be long stocks, bonds, real estate, so on and so forth. I think there are times you can take more risk, and there are times you can take less risk. And I think now would be a time to take less risk.
Are we at that point now in the cycle where it's time to take less risk?
I think so, yeah.
Jim, you spoke about bubbles. I think last week we had the all-time high at an auction for Picasso. The art market has been a major beneficiary around the world of all this money that's been printed. You've got some thoughts on Sotheby's.
Well, Sotheby's is a good example of not only a company that benefits from this type of easy money, and we've seen Sotheby's, if you look at a chart of Sotheby's, I mean, this stock ran up in the late 80s on Japanese buying of Impressionism. Yep. It ran up in the dot-com era on purchase of modern art by dot-com zillionaires and Wall Street people. It ran up again in the subprime era, and it's run up twice in the last few years. And it's really, it's an indicative barometer of the wealthiest and how they're doing. And I'd love to call art socially acceptable, conspicuous consumption, and I'm guilty of it as well as anybody. But having said that, I think Sotheby's is a very poor way to play it, because Sotheby's business model is slowly but surely deteriorating. And I'd like to point out that Sotheby's revenues last year, in real terms, are really not much different than they were in 1989, 25 years ago. And that's kind of a remarkable statement, given what's happened since 1989. And the reason for that is A, they're involved in just this absolute cutthroat competition with a private company, Christie's. Mm-hmm. But more importantly, it's what I call the rise of the super dealers, the Gagosians, the White Cubes, the Zwirners. And increasingly, collectors are able to buy art privately without a lot of fanfare, get financing, have deep inventories with the dealers, and not deal with the auction houses. And so that has eroded the franchise value of a Sotheby's much more than I think people realize. It's not what it used to be in terms of a business model. Put it this way, in the trailing 12 months, we think Sotheby's free cash flow is under 50 cents a share, and the stock is in the mid-40s.
And so the market's pricing almost double that, right?
Yeah, so well more.
So it could easily drop 50% in the next
and often
6 to 12 months.
By the way, in every bear market, Sotheby's usually goes into single digits.
So what other specific names, Jim, long or short?
Well, I think one of the areas that we're really negative on, Anthony, broadly speaking, for different reasons, is the energy space, and have been, and we're bearish well before the price broke last year, but for different reasons. I mean, we think the integrated oil companies have one set of problems, and then the North American E&P, the so-called frackers, have a completely different set of problems. But in the integrated space, we're just seeing that the cost of replacing oil, that these guys like Exxon and Chevron and Royal Dutch Shell, is really simply they're replacing $20 oil with $80 oil. And that's the problem. And so what were really high return on capital businesses are becoming more mundane return on capital businesses. And they're having to do things like drill in the Arctic, deal with Mr. Putin, construct these enormously expensive LNG, liquefied natural gas plants, and increasingly add the risk to the portfolio where it just used to be a much simpler, drill somewhere and pull the oil out.
So what specific names?
Well, I would be very leery of the very leveraged guys in any company that has running negative cash flow after capital spending. So they're not covering the dividends or their buybacks. So the names like Chevron, names like British Gas / Royal Dutch, and then of course some of the big national companies, the Petrobras's of the world.
The mom and pops that own these huge integrated oil companies for the dividend.
Yes.
The brokers for the
and
last
the brokers,
the brokers and the FAs for the last 3 years have been piling in their retail clients
Right.
into these names because they're not buying bonds given where interest rates are,
Right.
and they're buying them for the dividends.
Right.
I think
that would have been a wise strategy up until a few years ago,
Right.
when the companies were covering their dividends with cash flow. But in many cases, they're not
The fact
anymore.
that the financing
they're
the
borrowing,
dividends.
They're borrowing to pay the dividend now. And corporate finance theory, as well as other things, tell us that the riskiness of the firm is starting to go up dramatically on the same yield.
Let's talk about China, because you've spoken about it. The Chinese stock market continues to levitate.
Right.
How do you see this eventually playing out, where the fundamentals are going to catch up to the reality of that market?
Just step back a second. When we started looking at China at the end of '09, so early 2010, 5 years ago, nominal GDP growth in China was 15%. It was 10% real and 5% inflation. Nominal GDP growth today in China is about 7% reported real and 2% deflation. So here's the problem. And the problem is a credit story. And the Shanghai stock market, by the way, is a very bad barometer. We're not short Shanghai. We've never been shorted along the A-share market. When I started looking at China, it was 3,500. It went to 1,900, and now it's 4,300. And when it was at 1,900, nobody told me, oh, this means China, it's the end of China. It was just the Shanghai stock market. It's a retail market. Now that it's at 4,300, everybody's coming out of the woodwork to say China is turning. It's not. The Chinese banking system is bloated, and it's basically taking on more and more leverage. That same ratio is now 300%, Anthony. So in 5 years, they've more than doubled their debt to GDP. And I joke to my Chinese friends, but somewhat half seriously, another 3 or 4 years, they're going to be like my homeland, Greece. They're going to be at 400%.
All right, we're going to hold it right there. I'm surprised you still have Chinese friends giving your view of China, but we'll be right back in a moment.
Next on Wall Street Week.
Did some individual in some basement in the UK create the flash crash? Is that possible?
Email us at prosper@wallstreetweek.com. Wall Street Week is sponsored in part by PowerShares QQQ, leading the intelligent ETF revolution.
Vigor, resolve, tenacity. It's what drives us forward and propels us onward. But without it, mediocrity sets in. Complacency takes over. It halts you, stops you, leaves you staring from the same direction. It's a perspective that only offers so much, and it's why we seek out perspectives far beyond it.
Before investing, consider the fund's investment objectives, risks, charges, and expenses. Call 800-983-0903 for a prospectus containing this information. Read it carefully. Distributed by Ops Distributors, Inc.
We're back with Jim Chanos, Kinnikos Associates founder and president, and Lawrence Altman, founder of CBD Trading, who's one of the biggest traders of S&P futures contracts. Lawrence, welcome to Wall Street Week.
How difficult is it right now, compared to the last, say, 30 years, to actually look at the markets on a daily basis and actually think about trading and investing in these markets?
Trading is about pattern recognition. And so you're looking at the past, or you're looking at the past years, days, weeks.
But how does one think about investing in this world that seems to be such a non-correlated, manipulated world?
Well, I think the key is, as you said, is investing, because if you're going to trade, keep in mind you're up against people like Larry.
Right.
Or if you're going to be investing in speculative stocks, you're up against people like me and my staff. And you're not long-term, I think, going to win against Larry. So the point is, keep your costs low and be there. Just be exposed and save your money, right? Save and invest. Simple stuff, I know, hearing it from a short seller, but it's important. And number two, I think that you also have to understand perspective. I mean, I'm looking at fundamental situations that play out over a couple of years. I'm guessing if the markets were down 20%, Larry might feel differently, because he'd then be looking at a change in trend. And so it depends on your vantage point and what game you're playing. And not everybody's playing the same game.
How are you going to be preparing yourself in terms of thinking about what the Fed is going to do, and then what are the various outcomes that will happen, and then what will you do as a result of that, the way you're thinking about that?
Janet Yellen is saying things that are sort of hinting to what she wants to do. They want to raise the rates. They want to get things going. But they're so petrified of what the markets may do because, you know, we're living on this drug of free liquidity.
Doing what you do, if the Fed raises rates and you see the S&P take off, does that change fundamentally the way you think about 3 to 5 years based on the reality that it actually happened now?
Well, you know, the world that we live in today is this iPhone world or this communication world, and every morning a number comes out.
Right.
And there's a reaction to that number, economic, and you just have to judge, did it come in better than expected, and how did the market react to it? And we could go 3 weeks where good is good, and then we could go 3 months where bad is good, and then we could go 3 months where good is bad. So you really have to understand, and the way I look at it is just purely through price action.
Well, let's switch gears for both of you. Let's talk about the bond market. Are we in a bond market bubble?
I'm not one to make broad statements about such deep and liquid markets, but on the other hand, I'm not real excited about lending my money to the government at 1 or 2% or 3% for 30 years.
I think the bond market has told you in the last couple of weeks, the central banks are losing control. I mean, our Fed has a $4 trillion balance sheet. The fixed income market in the world is 100 billion, 100 trillion.
Lawrence, is some of it the tightness of liquidity, meaning there's a lack of liquidity in the markets too?
There is no more liquidity. I traded
so
bond futures.
It's a combination of fundamentals and lack of liquidity.
Yeah, but I traded bond futures for years, alongside S&Ps and options. The 10-year bond used to be 5,000 up, a point wide. Now it's a quarter of a point wide, and it's 300 up.
What does that mean to the average viewers? We all know what that means.
Basically, it means that 90% of the liquidity has been sucked out of the market.
The markets are lacking a lot of liquidity, not just in the bond, but the bond market being as large as it is an enormous problem.
I want to ask you both one thing, because obviously, I know, Larry, you've got to have some thoughts on this. The anniversary of this flash crash. Somebody's been arrested in the UK on speculation of gaming the system. Did some individual in some basement in the UK create the flash crash? Is that possible?
I will tell you, I've been trading for 30 years. I remember every trade and every price. The day of the flash crash, unchanged on the year, and the S&P was 1102.50. The S&P started trading that day at 1170, and they were going down pretty quickly, and the 200-day moving average was just below unchanged for the year. And all we had was stops that triggered stops at the unchanged, at the 200-day moving average, and there was a void of bids. And the market went straight down to 1056. It rallied right back up to 1133.
Did an individual manipulate it and cause that?
I will tell you
chance,
that
right?
I was long. I had been short earlier in the day, and I was long, and I knew what the numbers were, and I knew the stops were there, because after 08, people were scared to death. They didn't ask questions. They just got out. They didn't want to go through what they went through again. Now that has dissipated over the last 4 years. Now the first thing they do is buy, and they don't even care about the consequences of it.
Larry, Jim mentioned it earlier in the show about how difficult it is, even as the greatest short seller in the world, to trade against professional traders. Some of our viewers watch business television. They watch these shows about trading. They think that they could actually trade against the machines and trade against the expert traders like yourself. Can the viewing public find any advantage in trading against the machines or trading against the professionals? It's like going to the casino. How could I possibly watch a show about trading and trade against you?
You have to embrace what these computers are doing. I mean, they're following orders. So when they see it, when the computer sees a big order, it follows it. So you have to understand that the marketplace has changed, that where you thought a level was safe to sell or safe to buy, the computers will keep following those orders.
You can read those computers. But can the mom and pop investor at home watching business TV have any leg up watching the computers? They don't even know how to do it.
They're not really watching it. They just have to know that they're there, and that it's not a human being behind it, behind the orders. Where GoPro, for instance, the stock goes from 30 to 100, and people are saying this, but that stock was being bought and followed.
But I do think this goes back to Jim's point about having a portfolio of stocks, be patient, stay out of the noise. But I want to go back to what you guys were talking about at the break. You were referencing the '87 crash, the '08 crash, and the flash crash, and just relay some of those comments, Jim.
Well, we were talking about the difference between '87, when I think, as fair as say, Larry and I were both actually kind of terrified on Tuesday, Wednesday, Thursday after the crash, versus in '08 when things unwound in slow motion. And I was actually never worried about the system or getting paid in '08. I was in '87 because things happened so quickly. And Larry was talking a little bit about what he saw.
I was a specialist for spear leads and Kellogg. You know, imagine the spear leads and Kellogg. I had bought these puts on the opening. It was the equivalent of selling 50,000 shares of stock. And I went to buy the stock when there was no bid. And the partner came over, and she put her hand on my hand, and she said, "Do not buy a share of stock." Because Spear Leads was, in effect, insolvent.
Well, by the way, who was buying?
Yeah,
the short sellers.
So another reason why short sellers are so necessary for the marketplace. This is Wall Street Week. We'll be right back.
Wall Street Week is sponsored in part by CoCareers.com.
Every day you're getting things done. We're right there with you. We're helping farmers feed the world. With a roof over your head and the pillow beneath. We are fueling your tank and the shirt on your back. Our 60,000 American workers are exploring new ways to keep you moving forward every day. We are Coke.
We finally bought a place.
You seriously have enough saved to do that?
We've been putting a little aside each month.
So at the end of the month, we have nothing left to save. How is my account overdrawn?
When it comes to financial stability, don't get left behind. Get tools and tips for saving at feedthepig.org.
Wall Street Week is sponsored in part by Morgan Stanley, where capital creates change.
We're back with Jim Chanos and Larry Altman.
All right, we're running out of time, so we've got to switch to an actionable idea, Jim.
I'm going to say blanket, be short the North American frackers, E&Ps. Take your pick, do it in an ETF. It's a flawed business model. I agree with my friend David Einhorn. We've been short the space for 3 years.
I think the world should watch what happened to the largest commodity in the world, oil. Went from $107 to $40 in 3 months. And the idea that there was no bid on the way down, literally, for the largest commodity on the planet, should scare people into believing that when this ends, and everything always ends, and I'm not suggesting that the stock market's going to crash, but this will unwind itself.
So be long volatility, or what would be your actionable idea?
I just think that you should be cautious and not get caught into this.
Call Jim Chanos, that's a good one.
I mean, caution, you know, there is no liquidity in the markets.
So we're in the age of caution. There's no question about that. Gentlemen, thank you so much. That's it for today. You can check us out at wallstreetweek.com, and you can sign up for our newsletter. It's full of the latest market analysis. Gary and I wish you a prosperous week. Until next Sunday, we hope to see you on the new Wall Street Week.
The preceding program was paid for and presented by Skybridge Media, LLC.